Michelle Schneider's with us, I'm pleased to say, Managing Director over at Market Gauge Group, $250 million in assets under management, who can help digest what feels like a lot of volatility and almost some signs of capitulation in the market now.
Well, what's so interesting, Caroline, is that with everything that we know and that we're sitting here on the precipice of support, I really like to focus not so much on the S&Ps, but actually those inside sectors. So if we look at transportation and we look at retail and also the Russell 2000, you put in an 80-month moving average, which measures about a 6 to 7 year business cycle. If you subtract the blip in 2011 that we saw because of the government shutdown and then the pandemic blip, we've actually been holding it for about 11 years. So with everything going on, if you just look at that chart right now, you can say that if we, for some reason, can actually hang on to these levels, and it would be in IYT about 195, it is possible, and I'm certainly not saying that the bear market is over, but what I'm saying is it's possible that at least for the time being, we may be able to see some movement up and maybe some money coming back into the market. So that's really something I'm watching for.
Michelle, there's a lot of talk, though, right now about how what we're witnessing with regards to the market and ostensibly with the economy as well is a much more major structural shift. The idea that you have multiple generations, at least 2 generations, that have never seen yields at these levels, have never seen a dollar this strong relative to the major currencies at these levels, and that this isn't necessarily just going to go away or dissipate in a year or two.
Oh, yes, absolutely. And certainly this definitely makes the case for everyone looks like a genius during a bull market and not so much right now. But the other thing I'm focusing on, besides what I just mentioned to you, was also in terms of the commodities. And so, why are we here? Because the Fed isn't fighting this inflation, and yet a lot of people are talking about this demand destruction, and certainly we're seeing that. But what's under the surface that could cause more pain, but actually give an opportunity in the commodities markets, even though they've gone down a lot, is the fact that food prices, especially when you compare them to the pandemic lows and then once we broke out, are still quite high. Even though oil's come off, it's still quite high. And interestingly enough, the precious metals, which everybody has called dead, myself included in a sense, the gold is still outperforming the SPY. So that means one of 2 things. Either we'll see some kind of relief in the bond market, which will spike the inflation, but also falsely spike the equities markets, or the reverse will happen. The commodities markets will rise and there'll be more panic set in, as we're seeing even with food.
Do you see relief in the bond markets coming soon? i.e., does 4% on a 10-year feel like we're getting closer to peak?
Well, again, I think the Fed is so hyper-focused on some of the economic stats that are showing we're not in a deep recession yet. Consumer confidence, lagging indicator, but came in better. Durable goods were not great, but they were not that bad. Jobless claims have actually done okay. So, you put all these things together and you just think like the Fed, and they've been so myopic on that. They're saying what we're doing is fine. And so I don't see that end unless we really start to see economic statistics really dramatically fall, other than even housing prices were up a year to year. So yeah, that has to change before I think the Federal Reserve will actually change their mind as well.
Up year over year, for the first time falling month over the month though with that Case-Shiller report. I'm interested, Michelle, if you're looking still at the gold comparison to the SPY at the moment, what about cash? Are you seeing more and more people wanting to be putting it there?
Oh, absolutely, ourselves included. And we have a series of different models that are quant models that are all short right now. But the discretionary model that we're leading is over 90% in cash, which is a great place to be because it means that we're sitting there, kind of biding our time, waiting for an opportunity, whether it be in commodities or some of the equities. If this level I'm talking about in the key areas holds up, if semiconductors can actually stop the bleed at a 200-week. But yeah, right now it's kind of like the waiting game.
All right, Michelle Schneider, Market Gauge Group Managing Director, helping kick off today's show.